Good morning, good afternoon, and good evening. I am Emma Joyce, Head of Community at Global Digital Finance, and it's my pleasure to welcome you to our first Global Leaders Town Hall of 2021. This series is in partnership with the Global Blockchain Business Council, and today we have special guest Sharon Bowen, former CFTC Commissioner and co-founder of the Seneca Women Platform. Jeff Bandman, GDF board member, is hosting today's town hall. Jeff is widely recognised as a thought leader, speaker and educator on blockchain and crypto asset law, regulation and policy. He is co-founder and board member of Global Digital Finance and leads our regulatory engagement globally. Jeff was formerly a senior official at the US Commodity Futures Trading Commission, where he was responsible for the design and launch of Lab CFTC, the CFTC's innovation hub and the first established by US market regulator. Sharon Bowen joined the Intercontinental Exchange Board of Directors in December 2017. She serves as a member of the Bakkt Holdings LLC Board of Managers, where ICE has a majority ownership interest, and also serves on the boards of certain NYSE US regulated exchanges. In addition, she co-chairs the NYSE Board Advisory Council. Ms. Bowen brings more than 35 years of regulatory securities and public policy expertise. She served as a commissioner of the US Commodity Futures Trading Commission from 2014 to 2017. During that time, she was a sponsor of the CFTC Market Risk Advisory Committee. Ms. Bowen was previously confirmed by the US Senate and appointed by President Obama on February 12, 2010 to serve as Vice Chair of the Securities Investor Protection Corporation. She assumed the role of acting chair in March 2012. Prior to her appointment to the CFTC, she was a partner in the New York office of Latham & Watkins. Ms. Bowen's broad and diverse corporate and transactional practice of almost 32 years began in 1982 when she started her career as an associate at Davis Polk & Wardwell. She joined Latham as a senior corporate associate in the summer of 1988 and became a partner in January 1991 and continued at Latham & Watkins until 2014. Ms. Bowen also serves on the board of Neuberger Berman Group LLC. Ms. Bowen earned a Bachelor of Arts degree in Economics from the University of Virginia, a Master of Business Administration from the Kellogg School of Management, and a Juris Doctor from the Northwestern Pritzker School of Law. We welcome and encourage your questions. If you have a question, please feel free to submit them at any time using the Q&A box located at the bottom of your screen. I hope you enjoyed today's session, and I'd now like to welcome Jeff and Sharon.
Thanks so much, Emma and Sharon. It's such a delight to have you here with us. Thank you very much for making the time to join us today.
Happy to do it. Thanks, Emma, for that great introduction. And Jeff, thank you so much for having me for today's discussion. I'm really looking forward to it.
That's great. Well, there's so many topics to cover, and one maybe we'll start with since you're on the board of and have been a part of the journey of Bakkt. In our digital assets community will be familiar with Bakkt. Bakkt has captured a lot of attention, even from the time of its announcement, even before it launched. Can you tell us a bit about kind of the vision behind Bakkt and kind of where it is down the road of that accomplishing that vision?
Yeah, sure. Jeff, I will, of course, acknowledge that it was recently announced that Bakkt had filed to go public vis-a-vis a merger with a special purpose acquisition corporation. So obviously there are public filings that your listeners can go on to the SEC website and learn more about it. But I can't talk about what we were thinking about when we started Bakkt. It was really the vision to unlock the $1.2 trillion of digital assets that were being held in cryptocurrencies and rewards and loyalty points and gaming assets and with merchant store value. It started in 2018 with the vision of bringing both trust and transparency to digital assets. As you know, that's been a journey in and of itself. Through our Bakkt warehouse and the Bitcoin futures and options contracts, we also serve institutional clients on an end-to-end regulated market with true price transparency. For consumers, it's intended that Bakkt will aggregate all of the digital assets, that's, and all those points that we all have and don't know what to do with. We'll be able to aggregate those and provide liquidity and the ability to trade and transfer and pay however we want using those digital assets. And then for the merchants who are part of that ecosystem, they should see a lower cost of payment acceptance, enhanced customer engagement, and a decreased, loyalty liability on their balance sheets. So it's a really dynamic vision, if you will. So I was happy to be, part of the beginning of that.
That's fascinating. And so unlocking the points. So, if Bakkt had been kind of further along, does that mean, we all have all these airline miles that we weren't using in 2020. Does that mean we might have been able to, use them for something else through this type of platform?
Yep, you still can. You still have them, right?
Yes.
So it just means you didn't get that many more in 20, unfortunately last year because we weren't traveling. But if you're like me, I've got a lot of points that have just been sitting there. So I look forward to, maybe we can use that for travel when we can travel again. That would be great.
Yeah, we look forward to that. And then one facet of Bakkt, and as I understand, you're also on the board of that. Bakkt is operating a custodian, and so there's an exchange regulated by the CFTC, and then there's a custodian that's regulated by the state of New York, Department of Financial Supervision. Custody has been one of the great challenges in digital assets. What are some of your observations or learnings along the path to overseeing a custodian in this sphere?
So as you probably know, in following this, working with the regulators at the CFTC, it became apparent that we needed to solve for that custody piece. And to make sure that the assets were separate and secure, regulated through a trust. And so the New York State Department of Financial Services has been very enlightened in terms of regulating Bitcoin, bit licenses. So we applied for a trust, with the New York State Department of Financial Services. It's a really rigorous process. And, it's important because, one of the reasons I think why people didn't embrace, people being in the digital community, the institutional community didn't embrace Bitcoin was, the possibility of theft and the misuse of Bitcoin for illegal activities. And so all of the protections, know your customer, anti-money laundering protections, cyber protections, all of the protections that you would anticipate that are in place, with your securities, the same is true with respect to your digital assets, your Bitcoin, if you will.
Yeah, no, that's terrific. And yeah, the as much as crypto allows us to be your own bank, it's also sometimes not so easy to be your own bank, or the consequences of slipping up can be quite significant.
Well, we have some recent stories of people who can't find their PIN, got Bitcoin locked up someplace and can't quite get to it. So that's a bad for that person. I feel sorry for those people who can't find their PINs, actually, particularly given the fact that Bitcoin the price has gone up, exponentially in the last few months.
I saw one story of somebody they've got their passwords are stored in one of these iron key portable devices, and they get 3 guesses before it's irrevocably destroyed, and they've used one. It's quite a lot of value there at risk. So how is it that digital assets, whether Bitcoin, these other types of products and innovations, how did that first come onto your radar screen? What was that when we were all at the CFTC?
No, it was, and it's under Chairman John Carlo, who was very, very progressive in terms of embracing technology. Enduringly referred to as crypto dad. I fully supported his embrace of innovation and also the importance of having the the regulators, embrace innovation and to learn about this technology. And so, Jeff, you were our first head of, Lab CFTC, which seemed like a great experiment at that time, but, looking back on it, it was a smart move. And, sort of taking a leadership role, to meet with the new market participants so that we could be ahead of the game as regulators, while also, encouraging that type of innovation.
Yeah, no, and it was great to have your support for Lab CFTC, May of 2017, quite a journey since then.
Yes.
And in terms of, so, we've come from kind of 2017, we're at the beginning of 2021. How has your thinking about, or your vision of digital assets, how has that evolved during that time period?
Yeah, so pretty much just evolved as the market, has evolved. It just, when I think about the conversations that you could have a few years ago with people about digital assets and Bitcoin, that was a small universe of people you could actually even talk to, frankly. It's so that number is at least growing in terms of the people you can actually talk to. And innovation is occurring as we speak. People are coming up with great ideas and different use cases. It can solve for a number of areas of friction and inefficiencies in our financial systems. And so that's evolved. And our thinking about sort of the risk and the opportunities. I think that's evolving every day. And so I've been a close student, if you will, in following, since day one, what's happening in the market.
Yeah. Oh, yeah. And speaking of Chris Giancarlo, or Crypto Dad, you've also been working with him on in steering the digital dollar project. Can you tell us a bit about the digital dollar project? Oh, a bit of alliteration there. what it is, what's going on with it, where are the milestones, what's happening?
Yes, so the Digital Dollar Project is a partnership between the Digital Dollar Foundation, which Chris and his brother started in Accenture. And basically, it's Chris being Chris, taking the lead in looking at central bank digital currencies and whether we should be embracing that as other jurisdictions were taking a look at it. So one of the things he did was he collected a really great array of experts from academia, from market participants, federal, former regulators, basically to advise and to have sessions talking through some of the pros and cons and some of the use cases. There is a white paper that sort of serves as the backbone, if you will, of some of those discussions. And the intent with the white paper was for that to be the beginning of an open forum and dialogue to further engage the public and private sector, as well. So, but it's been really, really exciting. And we've learned from regulators outside of the US in terms of looking at their thinking about stable coins and central bank digital currencies as well, which has really been really fascinating.
That's it. In terms of the kind of the objectives and perspectives of the Digital Dollar Project, one of the things it's been advocating for in the U.S. is a public-private type of partnership. Is that something you support, and what do you see as the advantages of a public-private partnership approach?
Yeah, absolutely, and I'm a big believer in that. And you may remember when I started the market risk advisory committee at the CFTC, it was important for me to make sure that we had all the players at the table. And some of them were market participants who had never even had conversations with each other. They kind of talked past each other and told each other how they should be regulated. And so it's really an opportunity to get different viewpoints and to come up with some really good suggestions for us as policymakers at that time to consider. Likewise with the Digital Dollar Project and looking at central bank digital currencies and stable coins, I think you need that partnership. You need the innovators and the regulators at the seat, together, thinking about it. I do know that, the past administration, soon to be past administration, was not quite as receptive to the idea of engaging, the private sector. And, I think, Powell and Beckett are saying that, it's the job of the Fed to, take care of monetary policy, and that is their job. But given the multitude of use cases and the fact that innovation is happening, whether we regulate different market activity or not, I would definitely encourage, policymakers and regulators to engage all stakeholders in the process. It just results in just better decisions, frankly, at the end of the day.
Yeah, and I want to come back to that question of who's at the table and what the impact is on decisions in a moment. But before we come back to that, are you concerned that the U.S. is falling behind when it comes to these, central bank digital currencies or stable coins or these innovations?
Yeah, we are behind. I mean, you look at even some of the emerging economies are kind of further along in the process in finding ways to get funds in the hands of individuals who otherwise don't have banking relationships. They've found ways to have direct payments to individuals, and even where there isn't Wi-Fi, so you're not even dealing with the internet divide. People have been very, I think, creative, particularly in Africa and in India and emerging economies where it's been a necessity. I think in our country, we kind of thought, well, what's better and stronger than the US dollar, and so what could be better than the dollar? And yet, there's some inefficiencies in our payment rails and in our market infrastructure that's been around for, forever. And I think, we should be taking a look at the plumbing. And, I do think we can catch up. I do think we've fallen behind, but I do think we can catch up. We got the talent, we got the innovation to do that. So.
Yeah. Yeah. And you about the, well, yeah, I think there's an enormous amount of creative energy, here to be unlocked. So yes, you made a reference a moment ago to some of the challenges of getting payments to people in the payment rails. What do you think? What is the pandemic and the COVID response? What has that shown us, or what has that told you about it?
Yeah, that the pandemic was bad enough, and as you know, we're still suffering from the pandemic. Obviously, and the government, rightfully was trying to figure out ways to get money in the hands of people who had lost their jobs, because offices were closed, people who couldn't pay their rent, people whose kids couldn't go to school because schools were closed. It really kind of highlighted, I think, some of the inequities that have been there in plain sight, but kind of hidden, if you will. From a regulatory perspective, I think regulators didn't wake up typically in the morning thinking, how can I solve for, racial inequalities, including the, 10-to-1 discrepancy in white household wealth versus Black household wealth. And so, what happened was, the government did what they would typically do. They gave the money to the banks, with the intent that the banks would give the money and lend the money to communities. And, banks gave money to people that they had banking relationships with, people they could actually reach and they had, contact with. But, we've got a whole population of individuals who are underrepresented, the unbanked and the underbanked. Those tended to be minority and small businesses, who, traditionally, haven't had the traditional banking relationships. And so, even when there was an attempt, with the second go round to try to get money to the CDFIs, the community development financial institutions that are a little bit, closer to those underrepresented communities, they hadn't really thought through the fact that, the way the program was set up, you had to lend the money and then get reimbursed by the government. Well, the CDFIs didn't have the capital to, make the loans. Obviously the big banks could do that, but not, these local, CDFIs. So, it's, I thought that was a real problem, and it's partly because the right people were at the table. There weren't people at the table who knew anyone probably who was underbanked or underrepresented. Probably hadn't socialized with those people, probably didn't know them in their professional, personal ambit. And so in trying to solve for something that they probably thought was should have been a simple fix, turned out not to be a simple fix.
Yeah, and let's drill down about that more. When you said kind of people who are missing from the table, and I've seen you speak, and we talked in our kind of prep session about Chris Brummer's article about where all the Black regulators. What do you think the impact of that absence has been on the policy, the COVID response, even where we are now?
Yeah. I mean, Jeff, as you know, I was the first African-American commissioner of the CFTC. And when I stepped into that role, one of the things I said at my confirmation hearing, and one of my, ways I looked at every issue was to represent, those who didn't have a voice, those who had never had a seat at the policymaking table. So with all of our policymaking, I brought that lens to inform me in looking at issues in a different way. And so when Professor Brummer did his research and highlighted that, I think people were like astonished. And it wasn't just the chairman of the major regulators, it was all of the commissioners, and in turn all of their senior staff, so we're talking a couple hundred people, and not one of them was Black. And that's a problem. And so I really have encouraged this administration to kind of fix that void, if you will. I think we'll just have way better decisions and policy making when you've got diverse viewpoints at the table. Particularly you've got people making decisions about you being me as a Black person, but my voice isn't there. It's not there at the table. Yet, my money's in the market like everybody else's. It's in, retirement accounts and pension plans and at major banks. And yet, we don't have a voice. That's a problem.
Yeah. But you feel like the mindset or the kind of recognition of that has started to evolve?
We'll see. I mean, I am really I'm pleased with the picks that the Biden administration, the diversity that he's bringing. I've been very encouraged by that, which is good. And, I'm hoping to see the same, with the financial regulators that really regulate and oversee our markets as well. So I'm hoping that trend will continue to take place, if you will, with the future commissioners and chairs.
Yeah. And do you see digital assets as, something that can potentially be helpful when it comes to financial inclusion?
I think it can, and that the term financial inclusion has been used in all kinds of ways. People kind of mean different things, when they talk about it. In some respects, is having the underbanked and the unbanked that I'm talking about, having access to our capital markets. Some of it is, trying to provide identification, which is a big barrier to these individuals even having access to capital. They don't have a form of identification. So got lots of smart people out there who are thinking of different ways to get there. For example, with the COVID relief funds, there was a suggestion that, maybe individuals could have accounts at the Fed, and, not have to wait, 2 days, for their checks to clear, or to have their wages clear or their government benefits clear. Others had said, maybe let's, have the funds, be at the post office instead. But, because, people know where to find the post office. But what that says, and I think even with the white paper, we look at some use cases, whether, there are a lot of individuals who get government benefits, and even, whether you're talking about even your pensions that are paid by the government, or former service people, the military who get payments through the government. there should be a way to make that process, available to everyone. So financial inclusion for me is broader than just sort of race, although that's a real impediment because the underrepresented and underbanked do tend to be minorities. But at the same time, inclusion, I see that in a much broader sense in terms of bringing, sort of efficiencies, to our payment system and to our payment rails as well. So I really see that term in a really broad sense.
Yeah, broadly speaking, and it does seem like in other parts of the world, they've using whether cell phone technology or biometrics, whether we're talking about Africa with cell phones or India with Aadhaar, it does seem like there's at least experimentation
Mhm.
and application of trying to get people their government benefits through alternate channels.
And we should be looking at those. I mean, each of those use cases and coming up with our own. And again, engaging the great minds and the innovators that are out there. I think Libra was a wake-up call for our government. I think initially people weren't thinking about stable coins or there being a risk to monetary policies or any threats to fiat currencies, but that was a wake-up call. And we were, a little bit behind and not thinking that, oh yes, innovation is going to happen, the market's going to move. And so, those of us in the government, or those of us who have been in the government, need to be proactive in engaging innovation and not be reactionary. We have a tendency to react to bad things happening. It'd be great to be proactive instead.
Yeah, which can be hard. I mean, easier for a policymaker sometimes than for a regulator. But the technology moves so fast.
Mm-hmm.
Yeah, I mean, I think that I absolutely agree. Libra or now called DM. All the bits of it keep changing their names. So it was Libra and Calibra, and now it's DM and Novi, and maybe it'll be something else by the time it gets launched. But it was a big wake up call in terms of central bank digital currency, stable coins. All of a sudden, this sort of private company had the potential to compete with governments in monetary policy.
Mm-hmm. Yeah.
And provoking very strong reactions. I think particularly in Europe, but caught enormous amount of attention. And
Absolutely.
yeah.
That we should not have been surprised by that. I mean, if we did kind of been, again, if we had been engaging innovators in the private sector, we would not have been surprised by that. And that's again another downside when the public sector does not engage the private market. Particularly, where technology is advancing at such a quick clip. And particularly when we've got so many concerns about data privacy, data collection, et cetera. I think we really haven't thought through all the different ways that technology it's being embraced by the individual consumer, sometimes not even knowing how the data is being used.
Yeah, and people, I mean, perhaps that will change, or perhaps that's changing, but people often prioritize convenience over data protection.
Mm-hmm.
They just click, accept, and then whatever protections you've gotten, you've just given them away because you want to get to the story faster, or see the price of whatever you're trying to buy, or.
And Jeff, part of that also is somewhat generational. You got a whole generation of people who don't mind documenting their every move vis-a-vis, Snapchat and selfies, and so we know what they have for breakfast, we know what they're going to have for lunch, we know what they're going to have for dinner, and tomorrow when they're going to exercise. So it's there's a whole generation that's their life is open, and they've kind of embraced sharing their private lives for people to see. So which is different from the way I was raised, which is why you won't see me on social media that much.
No, you have a very limited presence on.
Exactly. But that's partly because, when I was at the agency, we didn't have any accounts. And so I literally, when I left, I just, haven't really engaged. I'm going to get better at it though. definitely. I'm going to get better at it.
It depends. I mean, I'll tell you, it's funny. So Chris Giancarlo of all the kind of commissioners and then chairman during my tenure was probably the most active, and he had a Twitter account and would put things out there and comment, and I think kind of the current the current and outgoing, I think they all have them. But when I was working on Lab CFTC and the blockchain and crypto stuff, it was really very, very hard to get information. There wasn't sort of a daily feed the way there was of derivative stories. So I went to the chairman's office and actually got permission to access Twitter from my CFTC desktop so that I could sort of follow what was going on in fintech and crypto. And at the time, I was probably the only person outside the Office of Public Affairs to have kind of a Twitter account. But that at the time, that was really the only way to find out what was going on. You'd ask people what's going on and then find out who they followed and follow them.
All right.
Well, I definitely want to ask you about the Seneca Women Initiative. I know it's something you're very passionate about and have spent a lot of time and energy to. Our audience in the kind of digital world may not be, or digital asset world may not be as familiar, but first maybe tell us a bit about what it is, and then probably want to learn a little more about it as well.
Yeah, sure. So Seneca Women is really named after Seneca Falls, New York, which is the birthplace, if you will, of the suffrage movement, of the right of women to vote in the U.S. We're celebrating our 100th anniversary of that right, although it took some 45 plus years for women of color to have that right to vote as well. But it was formed by Ambassador Milan Bavir and Kim Azzarelli about 8 years ago. Milan had been the first ambassador for women and girls in the Obama administration, and she really traveled, throughout the world, the globe, meeting with leaders and talking about the economic empowerment of women and girls. I think you probably remember Beijing, like Hillary Clinton saying human rights is equal rights is human rights. I'm sure I got that wrong, but you know what I mean. And so the whole concept of economic empowerment of women and girls really kind of resonated. She and Kim wrote a book. They did book tours. They advised some of the largest corporations on their women's initiatives and also on other initiatives to sort of give back. And so I knew Kim from many, many years ago, when I was a part of my law firm. She was an associate, and she came from an Avon, Goldman Sachs media background, and when she and Lynn asked me to come and join them and partner with them, I was really excited to do it because I got to kind of blend two of my passions. One is commitment to diversity and inclusion, and then my love for the financial markets. So my focus on the economic empowerment is how we can unlock the barriers to entry, the barriers to access to capital for women-owned businesses. We know that less than 5% of venture capital funds, less than 10% of bank loans go to women-owned businesses. And often when I speak, I say, women control, the vast amount, 75-80% of the purchasing power in the economy. Our money is in banks, our money are in private equity funds, our money's in pension plans. Yet we can't use our own money to lend to women. And that's been pretty perplexing to me. And so I've been spending the last year or so working to find ways to kind of unlock those barriers to entry. But we've done a number of things, including we have a website with tips and tactics. You can also download our app called Seneca Connect. It's free, and then we started a podcast network. So I spend time, not as much as Kim and Milan, doing podcasts where we interview women entrepreneurs and thought leaders and finding ways to amplify the voices of women and girls. And then, when COVID happened, we created a Women's Economic Future Fund And what that is we will make grants to Black women entrepreneurs, and then also make donations to nonprofits that support women and girls. And so people can find ways to donate, vis-a-vis our website or app, or, through a donation platform that we're establishing with MasterCard. But it's great. I mean, it's been a real pleasure, real honor to work with both of them, and to try to, fix, that's a problem that really needs to be fixed. And so I'm really determined to make sure we find a way to knock down those barriers that are there, frankly.
That's great. And for women entrepreneurs who are watching, what advice would you give to them?
Well, first, I would say download our app. Seneca Connect is free, because there you'll have the resources of lots of women entrepreneurs you'll hear their success stories. You'll hear like how they pivoted, when they had failures. And so that's one good thing I would say to do. And then the other thing I would say is I would encourage them to step outside of their comfort zone and to say it's okay to move forward. And you don't have to have a business plan that's 110% perfect. That just taking that first step is the biggest step. So I would just encourage them to get out of your comfort zone and just go for it.
Got it. And do you think a digital token could be somehow part of the Seneca Women, Seneca Connect, to maybe help to support or fund these women entrepreneurs?
I like the way you're thinking, Jeff. I like that idea. I really like that idea. To be continued. I really like that idea. So keep that in mind, okay?
Okay. We have a question from the audience. I'm going to take that and encourage anybody else who's listening. So thank you, Jeff, and former CFTC Commissioner Bowen. You're an inspiration. I think they're talking about you. How do we get more women and also underrepresented groups in positions of leadership and regulation? And what can private sector do to support that?
See, that's one of the topics we were talking about, right? Which is critical. Write to your congressman. I mean, write to your elected officials. Often for these regulatory positions, I mean, if you look at Professor Bremer's research, a lot of the people who take on these commission roles come from the Senate offices. They either were counsel to senators, the banking committee, the House Financial Services Committee. And so one way to start is to make sure our elected officials have on their staff diverse individuals and women, because that does tend to be the place where people find, commissioners, if you will. So encourage your elected officials to do that. Second, I think, particularly, this summer with the social unrest and the racial inequality, I think people really are focused on the inequities that have, some of the systemic barriers that have been there. And I think the pledges that corporations have made, and many of them have done more than just talk about it. They're doing things like funding scholarships, creating pipelines, making sure that that there is no reason not to have the resources there. I mean, for example, we started the New York Stock Exchange Advisory Council, made up of CEOs, partly to solve for the issue of how do we get more diversity on their corporate boards. We knew that the way typically people get picked for boards is through who the board members say, well, who do you know who would be good for the board? And so we thought, well, why don't we use this network, since networking seems to be the way that people get jobs and get these positions? Why don't we ask these CEOs to nominate women and minorities, nominate 5 or more that are board ready? And we will create that as a resource for our, thousands of New York Stock Exchange listed companies. So when they're looking for board members, they've got a resource, they've got a directory that they can go to. And, I'm really delighted, to be a co-founder and a co-chair of that initiative, because, part of it is just, you got to start somewhere. And so part of it is make sure people have access to the resources, making sure that they've got names in front of them. And even frankly, with this administration and, some of my conversations with people on the transition team, I've encouraged them. I said, we are going to have some Black regulators, aren't we? So not being shy to say, like, are we going to have any? We should have some. And if you need names, give me a call, because I can give you names of people who are super, super qualified to be in those positions. But the best way to do it is to hire people who don't look like you, to hire people who are diverse. And that's step number one. That's one way to fix this, to hire people who don't look like you.
Yeah, no, that's amazing. And I sort of see a common theme. First of all, sort of understanding how the process works, where it's, how people come up through the Senate, how people are selected by boards. So you understand how it works. And then, you use your, ability and agency to sort of improve things, sort of solve part of the problem by the root, by understanding how the process works.
Yeah.
That's pretty powerful.
It's hard to undo people's biases, Jeff, because we all have biases. And so it is human nature to pick people who look like you. But so people have to really be intentional. As I used to joke with people, I don't think, white men wake up in the morning saying, how can I discriminate against someone today and not give someone a job who's a person of color? But instead, nor do I think people wake up in the morning thinking, I want to be intentional about who we hire and to make sure we've got a diverse group of candidates. I want to make sure that I've got the best talent pool, which, by the way, is diverse. I want to make sure that I'm listening to my customers and my stockholders and my employees, who all know that, having diversity, we all now know we don't have to make the business case, because the studies are out there and the research is there that indicates that, diverse companies perform better. And so, but, companies have to just be intentional. You just have to say, I'm gonna hire someone of color, and just do it.
That's great. We have another question. Crypto derivatives are still nascent. Are you concerned about the proliferation of DeFi and derivatives on crypto with little guardrails and, I guess, little liquidity underpinning those derivatives?
Yes, I am. Which is why you need that private-public partnership, if you will. I mean, we definitely need rules of the road. We need standards. We need consistency. And we need that sort of globally, because we don't, as a former regulator, you don't want regulatory arbitrage where it's, easier to be in one market but not the other. And so the answer is, transparency solves pretty much everything, being transparent. But we need rules. And I think having rules will bring liquidity to the market. Transparency and rules, coming as a former regulator, I'm a big believer in both of those things.
Yep, makes sense. It's funny, like, I think the term DeFi, it's not really just one thing. There are a lot of things that are all sort of lumped in under this idea of DeFi, and some of them are probably truly new, and then others are probably things that have been around for a while that are just resurfacing under this new label.
Yeah, I love all the acronyms.
Yeah, it's nonstop new vocabulary.
Yes, absolutely.
Yeah. There's, let's see, we have another question. Can you comment on the banking license developments for Wyoming, I guess SPDI, Special Purpose Depository Institution banks, and then the various state trust companies in various states? I mean, I guess, you're on the board of one of those trust companies with Bakkt.
Yeah, so I can only really talk about New York State. I haven't really followed the Wyoming or sort of the other states, as well. But again, I think it'd be great, frankly, if the federal government could be equally as progressive and transparent, as well. It's really clunky to get 50 state licenses. It's sort of a clunky process. It's totally inefficient. It would be great to have harmonization and one rule fits all would in the best of our worlds kind of work. But we don't have that. But we do have a couple of, states that are, progressive, who are looking at this again with the same kinds of protections that you would expect, in terms of KYC, AML, cyber security, resilience, all those things that you would expect, regulators, state regulators to have in place. But I am a big proponent. It would be great if we just had one set of rules that applied and you didn't have to apply to 50 states. It's really pretty clunky, but frankly, it's not efficient to do it that way.
Yeah, no, it's pretty challenging having to do that. I want to go back to what we were talking about with the CDFIs, because I think it is a very kind of interesting and simple, once we drill back down on an example of government policy that, well-meaning, didn't quite work. But maybe could you first just sort of explain what CDFI stands for and what a CDFI is, and then we'll go back to kind of what the problem was with the approach of using the CDFIs.
Yeah, so CDFI stands for Community Development Financial Institutions, and they tend to be, and there are a number of them throughout the country, and they are typically focused on sort of the local businesses where they sit. Some CDFIs are, maybe targeted to specific audiences, either women businesses, et cetera. But for the most part, the big ones, tend to lend to businesses in their community. So they tend to be, like in New York, there's some big CDFIs because we have a lot of small businesses, in the States, like, New York and Texas, Florida and others, California, that have a large percentage of small businesses. It's where most of the largest CDFIs sit. And it's both sort of, it's a lending process, where they make loans to these small businesses. They too, they've got a board of directors, they've got the same kind of great corporate governance rules that you would expect, an institution to have. But, as I mentioned, they tend to have limited funds. They usually capitalized by grants and private sector, and in this case, and some government entities. But it's like, again, it's a clunky process. So it didn't really work because they didn't have sufficient capital to get those funds directly in the hands of those small businesses in their community, because the way it was set up was a reimbursement program, as opposed to here government, here's the government gives you the money and then you lend. Instead it was you lend and then the government reimburses you. And so I think we can restructure that process and do a better job, frankly, of using these institutions that are closer to the communities to be a conduit, to get funds in the hands of the underrepresented.
Yeah, and like during the government response to the 2008-2009 financial crisis, the government provided all this money to the banks, and then the banks didn't lend it out. So I can understand why this time around, when the government is designing a program, they say, okay, you lend out the money and then we've got it here, you go lend it out first and then we'll give it to you, which again, maybe for the large banks that worked, but for these other institutions that people didn't understand the dynamics.
Yeah, and that's why, it was sort of, you had like institutions that didn't need the money, getting the money. And many of them gave it back. Some of the universities and some of the large restaurant chains gave the money back because that wasn't really intended for me. And we'll be fine. This is really intended, for Joe's Pizza Parlor down the street, who employs, his neighbors and his neighbors' kids. That's who that money was for. And so you did have some institutions who gave the money back and said, no, give it to the people who really need it. And we all know, that small businesses are the engines for growth to our economy. And the only way we're going to get out of this, current economic crisis, if you will, is to refuel those small businesses. Again, they're the engine, of our economy. And and they were growing at a really great rate, before COVID, and a really great rate, post, the Great Recession. as well. And so seeing them so crippled and then not getting the help they need. I mean, Jeff, just sort of walking around New York City and seeing how many businesses are closed, most of them will not be reopening. They just won't. It didn't work, which is unfortunate.
Is a couple questions coming in. Let's see. So one about regulation and one about CBDC in China. So hopefully we'll have time to get to both. First, what's on your financial regulation wish list for 2021? What would you like to see the regulators address?
Oh, that's a really good one. I like that question. So a couple of things. So, and again, I think Biden probably has this right in terms of kind of the things that they're looking at. Like the first thing they're going to do is to fix, to get COVID under control and the vaccine. And that right now is the biggest impediment to our economic recovery is, getting people back to work, getting schools reopened, rolling out the vaccine. So that, again, that would be number one on my agenda. Again, I think Biden has said this, addressing the racial inequalities and some of the structural barriers to opportunities in housing, in healthcare, in jobs, in education would be important. Again, for our economy to grow, we need everyone to have equal opportunity to success. And so we have to get rid of those inequities that have stifled growth in our country. I think on the financial and technology front, I think, particularly when I look at former Chairman Gensler being nominated to head up the Securities Exchange Commission, I do think this administration will embrace innovation and technology. I think they will embrace digital currencies and fintech. But I also think, there will be that balance that has to happen with investor protection and data collection and privacy. So, I think we'll see sort of a balance of that. I think climate and sustainable finance, those also being disclosure as a market risk. And also, frankly, just going back to ESG for me, is not just about the environment. The ESG for me also is about diversity and inclusion. And so I would hope that the SEC would not only require disclosure on sort of climate, but also on diversity and inclusion as well. I'm a firm believer that for companies who don't embrace it, who aren't listening to their stockholders, their employees, and their customers, that's a market risk. If you are sort of if you have those blinders on, that's a market risk. And so I'm hoping that our regulators will require that kind of disclosure as well. We learned from the last, the Great Recession that our borders are, they're porous. Risk can flow back and forth, across jurisdictions, and our financial markets are totally intertwined. And so I think you'll see greater collaboration and cooperation among global regulators. I frankly was surprised when I came to the CFTC. I was surprised by two things. First, I just assumed all of the US regulators talk to each other and all, sit around the table and say, let's work together. I was surprised to find out that was not the case. That became more true, I think, when I was in office, and more true even today. And that's really important to sort of speak with one voice. But likewise, engaging regulators across the globe. I spent a lot of time speaking with regulators outside of the U.S. and meeting with market participants outside of the U.S., to learn a lot about their economies, including China was, one of my visits, as well. And it was really interesting in meeting with the regulators in China. On the one hand, they really want to open up their markets, but at the same time, they really don't like market volatility. I think they now, the word derivatives is not a bad word anymore, but I think they were really afraid of that word derivatives because it meant volatility and no control, and their government does not want to be blindsided by a financial crisis. So, they want to know kind of what's going on. The other thing I'll just sort of say too that I think will happen, I think you'll see this administration focus on the non-banks and the asset managers and the others who become significant players in our financial markets and in our broader economy. Many of them are not regulated. Asset managers are. Most of them are 40 Act registered investment advisors. We have a lot of institutions that are big players in our broader economy who are not regulated, and so I think we need to figure that out and what that really means. And again, embracing innovation by having the private-public partnership that's there. Because it's clear that our system is clunky, it's inefficient. The payment rails are not for today's future economy. And so we just need to be proactive there. We see other economies doing it. China is ahead in terms of, their use cases in using digital currencies and stable coins, if you will. So in other countries, adopting blockchain for their financial markets and exchanges. So that's a long-winded way of saying, there's a lot that this administration, my list is pretty long, unfortunately, but they're all kind of intertwined and all equally important.
Well, there's a lot. Okay, one final question to wrap up with, and you touched on it a little bit, but does the Chinese CBDC project represent a possible threat to the US or to the world monetary system?
I think time will tell. They definitely are ahead of the game there. They definitely are ahead of the game. And I do think we lost a little bit of our leadership position, and China's been in Africa. They've been in the emerging economies where we haven't been. But I again, as I said before, I think we can catch up. I don't think we're that far behind, and I think we have the talent and the will to be a leader there as well. But I would keep an eye out for sure.
Okay, well, I think overall an optimistic note to end up on. I want to thank you, Sharon, for joining us on today's Global Leaders Town Hall. I'd like to thank our audience live and those who watch the replay. Next week, our next Global Leaders Town Hall is on the 26th of January, where Global Blockchain Business Council CEO Sandra Rowe, and also she's a board member at GDF, will speak with Michael Casey, veteran journalist and author, to discuss his journey from senior columnist at the Wall Street Journal to chief content officer at CoinDesk and a leading voice on blockchain and crypto. Thank you again for joining us today, and goodbye.
Thank you.
Again, Sharon. It's been a pleasure.
Same here. Bye-bye.